There are four types of financial statements that are all utilized to convey certain information about a company. For some, though, these documents can be very difficult to understand and be the major cause for a headache the night before an exam. But hopefully you understand how easy they are to understand and prepare when given the correct tools and information. In order to complete a financial statement within an exam, I guess you're going to need a ruler, a pen or a pencil, and some paper. The first type of financial statement I'll cover is the income statement, or more formally known as a statement of comprehensive income. This is used when a company needs to report the profitability of their company, or more simply, whether the company is making money or losing it. It involves looking at the revenue and expenses of a company. Revenue refers to an increase in resources from the sale of goods or the provision of services. For example, getting paid to do something. An expense refers to a decrease in resources from the sale of goods or the provision of services again, but a negative. For example, using fuel to get from point A to B to make a sale. The second statement I'll be explaining is a statement of financial position. This is used when a company wants to know what their business owns and what their business owes. It involves looking at a company's assets, liabilities, and equity. An asset is a resource of the business, or what the business owns. The most common example being cash. A liability is an obligation that the business must fulfill at a later date with the sacrifice of an economic resource, such as accounts payable, salaries payable, and notes payable, or a loan. Equity is the difference between a company's assets and liabilities, as seen by the formula, and represents the share of assets claimed by the business owners. For example, contributed capital. The third statement I'll be exploring with you guys is the statement of changes in equity. This is useful for a business to examine how their equity is growing and how their equity is being distributed in the form of dividends. It involves looking at a company's initial retained earnings from the start of a period, their net income, and the dividends they've paid out to find the retained earnings at the end of a period. Retained earnings are what's kept at the end of the period after adding the profits and taking away the dividends paid out to shareholders. Net profit is generated from looking at the income statement, and dividends are sums of money paid out to shareholders on a regular basis. Finally, the cash flow statement. This statement is useful in finding out where a company's money is being generated and where it is being lost. It looks at three types of activities: financing, investing, and operating. Financing activities are activities involved in the creation of a business, such as contributed capital, where the individual funds their business, or a loan from the bank. Investing activities are undertaken once a company is on its feet, and an example is purchasing a product that allows you to generate revenue, such as a printer in a magazine company. Operating activities are those undertaken once equipment is acquired and are the day-to-day costs of operating a business. A common example is paying your staff. I'd like to thank you for listening to me with my screencast, and I really hope that it's helped you to understand the four different types of financial statements. Thank you.